The Simple Path to Wealth, a comprehensive summary outline. Introduction: Why Financial Independence Matters. J.L. Collins starts The Simple Path to Wealth by making a case for why financial independence, FI, and the pursuit of wealth matter for personal freedom, security, and peace of mind. He explains how traditional financial advice, such as relying on a high-paying job, saving for retirement in a 401k, and hiring expensive financial advisors, doesn't align with most people's best interests in the long run. He emphasizes the importance of financial independence, which can be achieved by spending less than you earn, investing the surplus in low-cost index funds, avoiding debt, particularly bad debt. The core premise of the book is that anyone can achieve financial independence by following a simple, clear path, regardless of their income level. Collins introduces the basic principle of wealth building, simple decisions, and intentional actions. The foundation of financial independence, he asserts, is not complex. Living below your means, cut unnecessary expenses, and save aggressively. Investing wisely. Rather than stock picking or chasing market trends, the book advocates for a simple, low-cost strategy of investing in index funds. This chapter sets the tone for the book by stressing the importance of avoiding distractions and focusing on basic principles that lead to financial freedom. Here, Collins goes deeper into the value of financial independence. He contrasts the idea of a traditional career path with the freedom that comes from financial security. The freedom to choose. Financial independence gives you the ability to live life on your terms without being beholden to a job for survival. Financial security. Rather than relying on a pension, Social Security, or a 401k, true financial independence means you control your wealth. Peace of mind. Financial independence reduces stress and provides peace of mind, knowing you are prepared for any eventuality. Chapter 3: A Better Way to Invest. Collins strongly advocates for investing in low-cost, broad-based index funds, specifically funds that track the entire U.S. stock market, like the Vanguard Total Stock Market Index Fund. His core philosophy here is that the stock market wins over time. Rather than trying to time the market or pick individual stocks, the key to long-term wealth building is to invest in the broad market and hold it. Low fees matter. High fees charged by actively managed funds or financial advisors eat into your returns. Collins urges the use of index funds with ultra-low expense ratios. The importance of patience. To succeed, investors need to be patient and avoid short-term speculation. Consistency and a long-term outlook lead to financial success. Chapter 4: Debt, the Silent Wealth Killer. Collins dedicates an entire chapter to the dangers of debt. He explains that bad debt hurts your wealth. Credit card debt, car loans, and student loans are the most dangerous forms of debt because they carry high interest rates and hinder your ability to invest. Good debt versus bad debt. While mortgages and low-interest loans can be seen as good debt in some cases, bad debt, particularly high-interest consumer debt, should be avoided at all costs. Debt freedom. Collins recommends paying off all high-interest debt as soon as possible to clear the path toward wealth building. Chapter 5: The Simplicity of Financial Independence. Here, Collins focuses on how financial independence is a simple goal if approached methodically. The 50% savings rate. Collins advocates for saving and investing at least 50% of your income to accelerate your journey to financial independence. He acknowledges that this may require sacrifice, but that it is achievable for most people. Living within your means. By keeping expenses low and focusing on saving and investing, anyone can achieve financial independence faster than they might think. Chapter 6: How to Build a Wealth Portfolio. Collins introduces the concept of asset allocation and portfolio building. Simple portfolio. A simple portfolio composed of 90 to 100% stock market index funds and 0 to 10% bonds is sufficient for most people. Vanguard Index Funds. Collins recommends funds like the Vanguard Total Stock Market Index Fund, VTSAX, for stock exposure, and the Vanguard Total Bond Market Index Fund, VTLX, for bonds, suggesting that these two funds can form the core of a wealth-building portfolio. He explains how investors can use these funds to benefit from broad market exposure while minimizing fees and complexity. Chapter 7: The Stock Market, Friend or Foe. Collins takes a closer look at the stock market and its historical returns. Historical performance over long periods like 20, 30, or 40 years, the stock market has provided consistent, above-inflation returns despite short-term volatility. Volatility is normal. He stresses that market drops and volatility are normal parts of investing, and investors should not panic during these times. The key is to stay invested and continue contributing to your portfolio. The role of bonds. While stocks offer higher long-term returns, bonds provide stability. A balanced portfolio will include a small percentage of bonds, which helps to protect the portfolio in market downturns. Chapter 8. The Mechanics of Wealth Building. This chapter focuses on the practical side of wealth building, specifically the importance of consistent contributions. Regularly contributing to your investment account, particularly through automated transfers, ensures long-term success. How to start investing. Collins gives a step-by-step approach on how to open a brokerage account, select your index funds, and automate contributions. Asset allocation. How to maintain the right mix of stock and bond funds, and when to adjust your portfolio as you near retirement. Collins discusses the goal of retiring early through financial independence and how the 4% rule plays a key role. The 4% rule. Based on historical market data, the 4% rule suggests that you can safely withdraw 4% of your portfolio's value each year during retirement without running out of money. The impact of taxes. Collins advises considering tax-efficient strategies in your investment plan to minimize the impact of taxes on your wealth. How much to save? Collins uses the example of the 4% rule to calculate how much money you'll need to retire early, emphasizing that higher savings rates and lower expenses can speed up the process. In this chapter, Collins touches on the psychological aspects of investing, avoiding emotional investing. Investors should resist the temptation to act on market fear or greed. Staying disciplined is the key to long-term success. The psychology of market downturns. Collins provides advice on how to stay calm and keep investing during market downturns, emphasizing that emotional reactions lead to bad investment decisions. This chapter reflects on the transformative nature of financial independence. Collins writes about how freedom leads to happiness. Achieving financial independence allows you to spend time on what you truly value, whether that's traveling, pursuing hobbies, or spending time with family. The legacy of financial independence also allows you to leave a legacy, whether it's financial or through the lessons you teach your children about wealth and life. The book concludes by reinforcing its core message. Financial independence is simple, but it requires discipline, patience, and a long-term view. Collins reassures readers that they can achieve financial independence by following a straightforward path, investing in low-cost index funds, saving aggressively, and avoiding debt. Key takeaways. Financial independence is achievable. With a simple and disciplined approach, anyone can achieve financial independence regardless of income level. Invest in low-cost index funds. The key to building wealth is to invest in low-cost, broad-based index funds that track the entire market. Avoid debt. High-interest debt, such as credit card debt, is the greatest enemy of wealth. Paying off this debt should be your first priority. Focus on saving. Save and invest as much as possible, ideally 50% of your income, to achieve financial independence sooner. The 4% rule. You can withdraw 4% of your portfolio per year in retirement without running out of money, assuming you've built a substantial nest egg.